Today, clinging to the wreckage, the Property Imperative Weekly to the 13th of April 2019. Hello, it's Martin North from Digital Finance Analytics. Welcome to our weekly digest of the latest finance and property news with a distinctively Australian flavour. And today we're going to explore in some detail recent data from the Reserve Bank, various expectations with regard to home price movements, and also a bout of enthusiasm in the US relating to banking stocks. But I have to tell you that the local news is pretty wobbly. And there's also a lot to cover, so this may be quite a long post. So hang in there, buckle up, and let's get started. And by the way, if you would like to support our work, you can do so via PayPal. Here's the link to make a one-off donation. Or subscribe via Patreon, where you can help us on an ongoing basis. The links are in the comments below as well, and we really appreciate the help of all those who are providing support to us to continue to make great content. So first, let's look at the Reserve Bank's Financial Stability Report. And in fact, I did a separate post yesterday specifically on the question of negative equity and the fact that they understated, in my view, the true state of play with regards to negative equity. So watch that separate show if you haven't already seen it. But they said that households are currently well placed to meet their debt obligations given low unemployment. Indeed, households have continued to make substantial voluntary repayments on their loans, albeit at a slower rate. Indicators of financial stress remain low outside the mining exposed regions, they say. Now, I disagree with that based on our mortgage stress. However, the value of housing loans in arrears has drifted up from very low levels. Yeah, we agree with that too. The risks associated with housing would increase with a rise in the unemployment rate or further substantial price declines. With weak housing market conditions, borrowers experiencing difficulties making loan repayments find it harder to resolve their situation by selling their properties. Housing constitutes a large share of household wealth, and further large declines in housing prices could cause households to pull back on consumption, particularly those who are highly leveraged. This, in conjunction with falling dwelling investment, could add to rising unemployment. Such a scenario would have adverse consequences for financial stability to the extent that it increases both households' likelihood of default and the losses banks would experience in the event of default. Housing price declines also increase settlement risks for apartments sold off the plan. And if valuations at settlement time are below the contract sale price, some buyers may find it harder to obtain finance and some purchases could fall through. Settlement failures remain low to date, they say. Further, some larger and diversified developers have low gearing and can afford to hold some unsold stock. Commercial property valuations, they say, continue to rise much faster than rents. Low long-term interest rates have underpinned high asset valuations globally, which could reverse suddenly with increased risk aversion or a jump in expected inflation. And highly leveraged owners of commercial property experiencing falls in valuations could breach loan covenants, which could result in sales and further price falls. In Sydney and Melbourne, office markets, vacancy rates are low and rents are rising, minimising these risks for now. In contrast, risks related to retail property markets have risen somewhat given weaker trading conditions over recent quarters and the subdued outlook for household consumption. Household debt, they say, remains high, but most indebted households can afford their debt repayments. Although lending standards have improved and housing credit growth has slowed, the ongoing high level of aggregate household indebtedness remains a key vulnerability. Highly indebted households are a key risk to financial stability, since they are more susceptible for falling behind on their repayments in the event of an adverse shock to their ability to service their loans, for example, rising interest rates or unemployment. Highly indebted households may also be more likely to reduce their spending if macroeconomic conditions deteriorate, and this could amplify the impact of any downturn. Most households, they say, are well placed to service their debt. However, the distribution of debt and prepayment buffers are uneven across households, and accordingly, a small share of borrowers remain relatively vulnerable. Despite housing price falls, household gearing levels are low in aggregate. Total assets are 5 times larger than stock of liabilities. Around 1/3 of households own their own homes outright, which contributes to the low aggregate gearing ratio. An estimate suggests that fewer than 5% of households have gearing ratios greater than 80%. And they say this small share of households are most exposed to the recent declines in housing prices because they require smaller price falls to tip them into negative equity than less leveraged borrowers. However, estimates and liaison with banks suggest that the share of households currently in negative equity is low. And households' total repayment on housing debt have been broadly stable as a share of household income over recent years. However, a greater share of these repayments are required rather than voluntary. Interest payments as a share of income have picked up a little, given recent modest increase in mortgage interest rates, and more notably, payments of scheduled principals are accounting for an increasing share of household income. The increase in scheduled principal repayments reflects a combination of factors, including rising debt, an increase in the share of loan repayment principals as the stock of interest-only loans have declined, and a modest aging of the loan pools because older loans pay proportionally more principal. Rising scheduled principal payments have recently occurred at the same time that unscheduled principal or voluntary prepayments have declined. And households are still making additional principal prepayments of around 1.25% of income, although this is down from 3.5% in 2015, and the aggregate stock of mortgage prepayment remains large. The stock of prepayments, the sum of balances in offset accounts and withdrawal facilities, accounts for 16.5% of the gross stock of housing credit, or a bit over 2.5 years of repayments at current interest rates. But nearly 30% of loans have no or little buffer, and so appear more vulnerable. And many of these have disincentives to prepay, like fixed rate and investor loans, and so borrowers may be accumulating savings outside their mortgage products. Another smaller share of loans with no buffers are new loans that have had little time to accumulate prepayments. And most of this latter group of loans may be expected to build prepayments over time, though they remain relatively vulnerable in the near term. With slower credit growth, the share of new loans with no buffer is likely to decline further. Now let me go back to that 30% to remind you that 31% of households, according to our analysis, are in mortgage stress. In other words, they're having difficulty making those repayments. And I think it's no coincidence that 30 to 31 is the proportion of households in difficulty. And then you say, well, RBA, are you sure that this is not a big problem? Because certainly I think they are understating it. So next, let's have a quick look at the property market. Now, the latest CoreLogic auction clearance rates continue the trend of relatively low clearance levels on extremely low volume, but slightly off the all-time lows. Overall, the weighted average was 52.6%, with Sydney slightly weaker than Melbourne this time around. But the thing to stress is just how low the total cleared auction counts actually are. And this, of course, is way, way lower than a year to 18 months ago. So there is very little here to indicate other than the market remains very weak. Now, the latest CoreLogic indices for home prices continues to show falls across the board. Sydney was down 0.12% over the week, down 0.29% over the month, down more than 3% over the quarter, down 10.9% annually and 14.2% from peak. Melbourne was down 0.25% last week, down 0.41% on the month so far, down 3.27% over the quarter, down 10% annually, and 10.7% from peak. Brisbane was down 0.19% last week, down 0.21% over the month so far, down 1.12% over the quarter, down 1.8% over the last year, and down 1.5% from peak. And Adelaide was down 0.05% last week, down 0.07% this month so far, down 0.5% over the quarter, annually up 0.5%, but 0.6% down from the previous peak. And Perth is down 0.15% last week, down 0.15% over the month so far, down 2.78% over the quarter, down 7.9% annually, and down 18.2% from peak. And the major 5 overall averages are down 0.15% last week, down 0.28% over the month so far, down 2.7% over the quarter, down 8.7% annually, and down 10% from peak. And that national average of 10% is one of the highest that we've seen for a very long time. Now, NAB produced these charts which just highlight where the current fall lays relative to other declines in the past. And the story really is that the decline so far is quite significant, but not necessarily as acute as previous episodes. The home price declines are more common in real terms, and the fall in Australian real home prices to date is modest compared with the international experience post the global financial crisis. Ireland, of course, saw prices drop more than 50%, and even in the US, they were 40% down from peak to trough. And the decline in net housing work to date is one of the largest in the post-Second World War history. And that is probably more concerning because that suggests more declines ahead. Now, Morgan Stanley says that the peak-to-trough real price decline in home prices is tracking towards the top of their 15 to 20% range, with risks to the downside. And while eventual RBA cuts will provide some support, they don't expect that they will have the same credit boost as previous cycles. Housing weakness is likely to persist through to the end of the year at least, with further downside on both approvals and prices. Credit supply is holding at very tight levels, with little relief expected post the completion of the Royal Commission. With the pipeline of housing construction still elevated, the supply-demand surplus drove weaknesses in the quarter, and they don't expect this to close out until the end of 2020, even with sharp declines in approvals. Despite the slowing in credit growth, mortgage serviceability continues to worsen, reflecting the high leverage, increased lending rates, and low income growth faced by households. And NAB says the trend decline in foreign buyer activity over the course of 2018 has continued into 2019. In quarter 4, the market share of foreign buyers in Australian housing markets fell to just 4.9% from a 6.5% in quarter 4, and a survey high of 16.8% back in the third quarter 2014. And 3.5% in established markets, broadly unchanged from a survey low 3.4% in the previous quarter. In new housing markets, the share of sales to foreign buyers fell below average levels in all states. In key markets, Queensland now leads the way for foreign buyers with a market share of 6.7%, compared with 7.9% in quarter 4. Queensland has also overtaken Victoria as the biggest market for foreign buyers, with market shares in Victoria falling to 4.8% in the first quarter 2019, compared with 8.3% in quarter 4, well below a survey average of 13.9% and a high of almost 33% in late 2014. In New South Wales, market share also fell to 4.1% in the first quarter 2019, down from 4.6% in the fourth quarter, and also well below the survey average of 9.8% and highs of around 21% in early 2015. In established housing markets, the share of sales to foreign buyers was also unchanged at near survey lows of 3.5% in the first quarter 2019, compared with 3.4% in the fourth quarter. Foreign buyers were most active in Victoria at 4.8% and least active in New South Wales at 3%. And the share of foreign buyers in established housing markets is now well below survey averages in all states. Now, the ABS reported that the number of dwelling commencements fell by a seasonally adjusted 16.3% over the December quarter and were down by 16% over the year. Detached house commitments fell by 7.6% over the quarter and by 10% over the year, whereas unit commencements fell by 26.8% over the quarter and by 23% over the year. And BIS Oxford says housing construction will fall 30% from peak to trough, and the pullback in new home starts will be greater than the average 25% decline seen across the past 9 construction downturns since the mid-1970s. The 2-year decline equates to about 70,000 fewer dwellings, double the size of the 3 prior downturns, but follows a boom that added about 85,000 to the country's dwelling base, the BIS figures show. And S&P says that the outlook for Australian corporates has darkened in their report, Australian Corporates Vulnerable to a Thrifty Consumer. They say that Australian corporates are vulnerable to a confluence of domestic risks. This is in contrast to past slowdowns that have been associated with global cycles, often via the resource sector. In particular, deteriorating household conditions foreshadowed tougher times for industries that rely on consumer demand. As household conditions worsen, it's likely that consumption will pull back and savings rates increase. Household savings rates are near their lowest point in a decade. Over the past 5 years, household consumption growth has averaged 2.5%, whereas household disposable income growth has averaged only 1.9%. They believe that a rise in the household savings rate poses the greatest near-term risk to Australian corporates. A rerun of the 2009 fallout from the global financial crisis is the worst-case scenario. However, such a rapid run-up in savings would likely require an employment shock, which they do not anticipate. Their base case operating scenario is more chronic than acute. They forecast that consumer-facing companies will muddle through an extended period of subdued demand. In particular, companies exposed to greater competition and discretionary expenditure are at greatest risk. This includes retailers and their landlords, media and telecommunications, consumer product companies, and airlines. And they don't see any white knight on the horizon this time around. The current rebound in commodity prices hasn't made its way to households to the same extent as past episodes, and they therefore expect pressures facing households to build. They suggest fiscal policy has the greatest capacity to support households, and monetary policy support is restricted to 1.5%, even if they assume that rate cuts are fully passed on to borrowers. Similarly, a wide variety of opinion polls suggest that community support for population levers has waned. The timing and effectiveness of fiscal policy will therefore be of critical importance. Consumer spending accounts for almost 60% of GDP, and commodity prices rebounded in 2016, yet income did not flow through to households to the same extent as in past episodes. Although government tax receipts have improved, fiscal repair took priority over expenditure measures directed at households. And the government's fiscal response to the global financial crisis was to go hard and go early and to go to households. However, it is these same households that are increasingly relied upon to fund fiscal repair. Iron ore prices have benefited from Chinese easing as well as supply constraints following tailing dam failures in Brazil. And coal prices too have been robust. That said, high commodity prices have done little to elicit new supply, noting that it is the construction phase that stimulates the greatest demand for labour. Rather, there are recent examples of major mining houses downsizing their workforce despite higher margins, and they expect prices for Australia's key commodity exports to steadily decline over coming years. Liquefied natural gas, LNG volumes, have also ramped up over the past few years. Nonetheless, supply imbalances are likely to weigh on revenue growth, and high depreciation rates and past write-downs mean there is little near-term taxable income for the federal government to reallocate to other parts of the economy. And in addition, existing price mechanisms have buoyed gas and energy prices on the East Coast, adding to households' cost of living. High energy prices and otherwise stronger currencies have also affected the competitiveness of East Coast businesses more generally. And immigration policy has been instrumental in propping up consumer demand, but net overseas migration has materially outpaced its long-term average and adding 1% to total population growth of 1.7%. This is extremely high by global standards. The headline employment figures have been strong, but the combination of rapid population growth, sectorial shifts, automation and changing forms of labour market attachment, for example casualisation, has given rise to a persistent amount of labour market slack, putting downward pressure on wages. The unemployment rate remains stubbornly high, and Australia had endured one of the highest output gaps amongst OECD members, albeit improving somewhat of late. Australian corporates have been the clear beneficiaries of population growth via higher consumer demand, filling skills shortages and keeping a lid on wages, and households, however, have had to contend with the increasing demands placed on public services, infrastructure and housing, as well as a diluted share of the country's natural resource endowment. And sluggish productivity has resulted in GDP per capita growth that has been increasingly flat. Population growth in Australia's major capital cities, combined with lower interest rates, supply constraints, loose lending standards and offshore demand to unleash a residential property boom. Sydney and Melbourne house prices peaked in 2017, and Brisbane and Adelaide are now falling too. Housing activity spilled over to adjacent sectors of the economy via a higher multiplier, as well as a wealth effect that has kept consumers spending. Both appear to have reached their limits and are turning negative. And household balance sheets became increasingly stretched as buyers chased rising house prices and households borrowed to support living standards. And offshore demand for Australian bank assets, coupled with loose lending practices, created the conditions where credit flowed freely to households. Australian households are now among the world's most indebted, although low interest rates have kept servicing manageable. The role that rising property prices played in supporting consumption expenditure in the wake of the commodity downturn appears to have run its course, and economic activity is increasingly driven by infrastructure projects in Sydney and Melbourne as these cities attempt to narrow infrastructure deficits built up over years of strong population growth. These two cities dominate employment growth, and there are some signs that wages growth is beginning to pick up. However, the infrastructure pipeline may not have long to run before it too begins to subtract from growth. And Moody's says that the Australian housing market has further to fall in 2019. The March CoreLogic Hedonic Home Value Index results show declines across capital cities led by Sydney and Melbourne. The National Index for Home Values has fallen for a year and a half, and the decline has been sharper in house values compared with apartment values. House values have fallen over 9% from their peak in late 2017, while apartment values are down around 6% from their peak. And after a 12.8% rise in 2017, home values across Sydney declined 5.5% in 2018 and are forecast to fall a further 9.3% in 2019 before a slow recovery in 2020. And apartment values are set to decline at a slower pace, down 5.9% in 2019, followed by a slow recovery in 2020. And house values in Melbourne are forecast to decline sharply in 2019, following a modest correction in 2018. The majority of the decline and slowdown will be concentrated in the inner Melbourne regions. Melbourne's apartment market is also expected to correct in 2019 and 2020, following a sharp slowdown last year. And house values across Brisbane are forecast to see a correction in 2019, with strength in East Brisbane offset by declines elsewhere. The worst is likely over, they say, for Brisbane's apartment market. Apartment values are tipped to recover by 0.9% in 2019, followed by stronger growth of 5.8% in 2020. Despite commodity prices stabilising, house values in Perth will likely decline 7.6% in 2019, followed by a small recovery in 2020. And a slow housing recovery in 2020 is likely as the local economy improves, thanks to population growth. And Adelaide's housing market will continue its stable run, with house values forecast to rise 1% in 2019 after a 1.9% gain in 2018. But I have to say, I'm just not sure where these rebounds are going to come from. Certainly, prices will fall this year. But I have to say that the prospective uplifts next year seem to me rather surprising. Now, Ernst & Young in the AFR says that over 60% of households are extremely concerned about the increasing cost of living, the cost of essential services and increasing energy prices. It seems that more households are not paying down debt because they do not have the capacity to do so. And this is one reason why advanced arrears were comprising more of overall arrears. Households with their higher levels of debt are more sensitive to changes in the economy. And the Standard & Poor's Performance Index, the SPIN index for Australian prime mortgages, rose to 1.45% in January from 1.38% a month earlier. January is typically the peak of the arrears cycle, reflecting the after effects of Christmas and summer holiday spending. And the magnitude of the increase at this point in the arrears cycle is lower than in previous years. And the rise in mortgage arrears was consistent nationwide, with the exception of Tasmania, where arrears fell to 1.1% from January, from 1.2% the previous month. The Northern Territory recorded the largest increase in mortgage arrears in January, reaching 3.16%, up from 2.77% in December. In originator portfolios, the regional banks recorded the highest level of arrears, followed by the major banks. The higher level of mortgage arrears in regional banks' portfolios reflect their higher exposure to Queensland, Western Australia and South Australia. And these states have experienced more elevated arrears for a number of years. And the total loans outstanding in the regional banks' residential mortgage-backed securities sector has declined about 34% in the past 5 years. Loans in the more advanced stages of arrears have increased to 1.42% from 0.62% during this period. And refinancing conditions, they say, are likely to remain tough for loans in Queensland, Western Australia and South Australia, particularly in regional areas. And so they expect arrears in these portfolios to remain elevated for some time. And investor loans recorded a larger increase in arrears than owner-occupied loans, rising to 1.4% in January from 1.27% a month earlier. Owner-occupied arrears increased to 1.69% in January from 1.60% a month earlier. The increases might reflect the ongoing transition from interest-only to principal and interest repayments, which is more common for investor loans. And they expect refinancing pressures to continue in the current environment of tighter lending conditions. They say high household indebtedness increases borrowers' sensitivity to changing economic conditions and interest rate movements. And this vulnerability is greater for borrowers with weaker credit attributes, such as those with high loan-to-value ratio loans. Exposure to loans with higher credit risk is not material in most retail mortgage-backed securities portfolios and is unlikely to put any significant pressure on arrears in the short to medium term, while employment conditions remain stable. Now, it's worth reflecting on the fact that the BBSW has come way down. It's lower than this time last year now, and as a result of that, a number of banks are cutting their mortgage rates. CBA and Westpac have both announced cuts, as others are now following. So we can expect to see a lot of competition for fixed rate loans over the next little while. Of course, this also puts downward pressure on net interest margins. Now, the IMF published a report on Australian household debt, and made the point that in fact high household debt is spread significantly across pretty much all household segments in Australia. It is not just associated with the wealthy. And in the context of their down forecast of growth at 2.1% in Australia and their concerns about high household debt, this falls in line now with many other predictions of more difficulty ahead. Now, CoreLogic's latest data showed that the rental changes over the last year have been quite disparate, with Darwin down the most, but Sydney not far behind. On the other hand, considerable rises in Canberra and Hobart, to the point now where many people in Canberra are having to pay higher rentals compared with Sydney. But I think the significant falls in rents in Sydney highlights the fact that more investors are going to be underwater in New South Wales, and we've already got a high number of people in Victoria who are also losing money on their property investments. And so to the markets. Locally, the S&P ASX 100 was up 0.85% on Friday to end at 5,148. The volatility index was down 4.48% to 10.81 on Friday. The S&P ASX Financials was up 1.6% on Friday to 5,861, and the ANZ Banking Group was up 2% to 2602. The CBA was up 1.95% to 7163. Commonwealth Bank boss Matt Comyn is believed to be working on a plan to cut more than 10,000 employees, about $2 billion in costs, at Australia's biggest and most profitable bank. No wonder Comyn wants to keep the plan secret, at least until after the May 18 election. Margin calls have learnt of the bank's previously unknown plan to dramatically reduce its workforce in coming years, as Comyn's executive team, including newish Chief Financial Officer Alan Dockery, tries to please profit-focused investors. And the Finance Sector Union has demanded Commonwealth Bank Chief Executive Matt Comyn come clean on these reports that the bank is planning to chop its workforce by 20% or 10,000 people and closing branches. The union described these as outrageous acts, while analysts said the widespread adoption of digital banking means banks will continue to cut operating costs to maintain profits. And by the way, CBA is not the only bank attempting to push costs down. The National Australia Bank was up 1.02% to 24.69, and Westpac was up 1.37% to 25.92. Amongst the regionals, the Bank of Queensland was down 2.12% to 8.76 on a very poor result, both in net interest margin terms and also cost control terms. And they are demonstrating the issues with regard to low momentum in the mortgage sector and high competition. Suncorp was up 1.20% to 13.45. Bendigo and Adelaide Bank was up 1.37% to 9.63. AMP was up 0.9% to 2.23. And Macquarie Group was up 1.12% to $132. Genworth and Mortgage Insurer was up 2.94% to 2.45. Mortgage Choice was down 3.8% to 88 cents. Yellow Brick Road was level at 6.7 cents, and McGrath was down 1.96% to 25 cents. The Aussie dollar to the US was up 0.69% to 71.72, and the spot gold Aussie dollar cross was down 0.84% to 1,799. Over now to the US markets. US stocks closed near record highs on Friday after the largest US bank, JP Morgan Chase & Co., soothed worries that the first quarter earnings season would dampen Wall Street's big rally back from last year's slump. JP Morgan effectively jump-started the quarterly earnings reporting season that will dominate investor sentiment in coming weeks. They blew past analyst estimates, easing fears that slowing economic growth could weigh on its results. Its stock rose 4.7% and led a broad rally in bank stocks. Financials were the largest percentage gainer, rising 1.9% on the back of the JP Morgan Chase earnings. But Wells Fargo fell 2.6% as its above consensus earnings was overshadowed by a weakness in its consumer lending business. Investors also had to contend with more bad news. Interim CEO Alan Parker downgraded the bank's outlook on net interest income to a range of -2 to -5 from a previous -2 to +2 range, citing a lower rate outlook, a flatter curve and tightening loan spreads. The S&P 500 is now within 1% of September's record closing high, and the S&P 500 Total Returns Index, which includes reinvested dividends, in fact regained record levels, recovering ground lost after a punishing sell-off in the closing months of the year, which brought the benchmark index within a rounding error of bear territory. Since then, the three major indices notched their best quarterly gains in nearly a decade in the first quarter, but have spent April in a holding pattern ahead of first quarter earnings seasons. Analysts now expect S&P 500 companies to show a 2.3% year-on-year decline in earnings, slightly improved from their last reading, but first quarter profit is still logging its first annual contraction since 2016. However, of the 29 companies in the S&P 500 that have reported thus far, 79.3 have come in above analysts' expectations. The Nasdaq and the Dow are both about 1.5% below their previous record highs. For the week, both the S&P 500 and the Nasdaq showed their third straight gains, while the Dow posted a nominal weekly loss. The volatility index, Wall Street's so-called fear gauge, slipped to a fresh sixth-month low on Friday, in a sign investors expect the good times to keep rolling. The Dow Jones Industrial Average was up 1.03% to 26,412. The S&P 100 was up 0.62% to 1,281. The S&P 500 was up 0.66% to 2,907. The volatility index in the US was down 7.76% to 1201. The S&P 500 financials was up 0.56% to 442, and Goldman Sachs was up 2.47% to 207. The Nasdaq Composite was up 0.46% to 7,984. Apple was down 0.04% to 198.87. Google Alphabet was up 1.09% to 1,222. Amazon was down 0.05% to 1,843. Facebook was up 0.9% to 179.10. Intel Corporation was up 1.1% to 56.42. And the 10-year bond was up 0.06% to 2.56. The 3-month bond was up 0.36% to 2.43. And the US dollar index was down 0.34% to 96.85. The pound US dollar was up 0.19% to 1.3079. And the FTSE 100 was up 0.26%. The FTSE Financials Index was up 0.3% to 691, and the Royal Bank of Scotland was up 1.05% to 260. The Euro US dollar was up 0.49% to 1.1306, and Deutsche Bank was up 1.72% to 754. While markets followed developments in trade talks between the world's two largest economies, China produced some mixed trade data to end the first quarter on Friday. Chinese exports rebounded to a 5-month high in March, beating expectations and providing some relief over the outlook for an economic recovery. At the same time, however, imports plunged more than expected, falling for a fourth straight month and matching the decline seen last December. Peeking through the data, the Chinese Customs Department indicated that Chinese total trade with the US actually slumped by 11% in the first quarter, driven by a 28% plunge in imports from the US. And during the month of March, China's imports from the US fell by 21%, whilst Chinese exporters sent 10.6% more of their products to American consumers. Although some analysts commentated that Chinese exports may have been affected by seasonality, the numbers give the impression that the current state of trade may not be coming out in favour of the US. And the Chinese yuan US dollar was up 0.22% to 0.1492, and bulls piled back into oil on Friday, pushing the rally to its best stretch in nearly 2 years, on the back of continued unrest in exporter countries in North Africa, and data showing a slight year-on-year rise in Chinese imports. And the crude oil futures was up 0.35% to 63.80. Gold futures was up 0.03% to 1,293. Silver futures was up 0.39% to 1492. Copper futures was up 1.87% to 294. And the Bitcoin US dollar was up 1.23% to 5,110. Unable to show growth confidently above 5,300, Bitcoin turned to decline this past week. Nevertheless, the current dynamics is more like a cautious profit-taking, since cryptocurrencies are much more volatile, sometimes showing very sharp fluctuations in the direction of growth or decline. An 8% drop in the flagship cryptocurrency from 5,400 to 4,900 fits into the definition of a correction after a jump from levels near 4,100 and returns us to the levels of the end of the previous week. Meanwhile, very disturbing news for Bitcoin came from China. It seems that a ban on ICOs and crypto exchanges is not enough for the country's authorities. Now the mining sector can also be banned. Obviously, in this case, the costs of mining will increase. On the other hand, in turn, this can be an important price growth driver. In addition, many market participants were cautiously looking at the centralization of computing power in China, and now some of their fears can be dispelled. But I say again, my view is that Bitcoin is a completely speculative asset. So after that marathon, what can we discern? Well, I think that locally, the evidence is continuing to build for more home price falls, for more difficulty with household debt, and a spillover into the broader economy. I think the IMF forecast this week was very significant, and I still think the Reserve Bank is over-optimistic. It probably has to be because it's trying to talk its way out of a problem, but I think we're going to continue to see falls ahead. Meanwhile, internationally, the US market is just firing away, as expected, and we do expect the US market to continue to rise for the next little while. But at some point, momentum will run out, and then we're going to start seeing falls there too. So there's nothing in this data that suggests to me other than the uncertainty that we've seen in recent months will continue, and as a result of that, I think we have to expect more downside news here in Australia, more difficulty with home prices, slower lending, and higher levels of mortgage default. I'm afraid clinging to the wreckage is probably the right strategy. And before I go, just a quick reminder that on Tuesday, the 16th of April at 8 p.m. Sydney time, we're going to run our next live stream event, where you can ask me questions in the live chat or send them through beforehand via the DFA blog. We'll look at our latest scenarios and the latest set of information and try and work out what's happening with the property market and the finance sector in Australia and New Zealand. Hope you can join us there. Here is the link, and it's also in the comments below. If you found this post useful or insightful, please like the post, share the post, add a comment or question. I read them all. And if you haven't yet subscribed, please do so to receive future alerts. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.